it's been really interesting, Danielle, to watch the growth of your company and see the data that you guys are putting out. Is a liquidity crunch coming for startups?
Well, it's hard to predict, but right now, based on what we're seeing, there's definitely a lagging effect. So actually, we're seeing the highest weeks of startup funding, so week by week by week, still over $1 billion each week getting put into the market. So what's happened last week and this week, we don't really seem to see that playing out. That being said, it's been very low activity this week, and we're hearing from investors who are our customers that a lot of people are in wait-and-see mode.
So, how big a cash crunch are we talking about?
Well, we're talking about over $1 billion every week going to startups. So we're probably going to see this play out in the barbell effect. The big companies stop getting these 100 million plus rounds, and the Series A companies, maybe the top of the funnel gets a little bit smaller. So we could be talking about hundreds of millions of dollars every week not getting invested.
Now, on the one hand, we're hearing a lot of investors like Bill Gurley warning to start prioritizing profits over growth. Yesterday, I spoke to the CEO of Workday, Anil Bhusri, who said, yes, we are in a bubble in private tech, and VCs are going to get hit when this all plays out. On the other hand, I just spoke with Marc Andreessen, who is a lot more optimistic. I mean, he's not completely, seeing through these rosy-eyed glasses, but, he's a lot less dire about what's coming. Take a listen to what Marc Andreessen told me.
I think situation normal. These are startups. Some of them are going to work really well. Some of them are going to not work at all. In some environments, it's easier to raise money. It makes sense to prepare for environments in which it's not as easy to raise money. To me, that doesn't, though, translate into a call for everybody to panic.
So, it's just there's not that same sense of urgency. He says no need for everyone to panic. What do you think of what he's saying?
I think a lot of things kill startups. Aside from liquidity crunches, right? Just bad decisions, wrong market, wrong hires, wrong team, can't raise more money because you don't hit the milestone. So I think what he's really saying is, really, if we're panicking all the time. It's always hard, and this is just one of those other factors that we can't control that we now have to consider.
And we've actually got a few charts that you helped us build with the data that you compiled showing private versus public capital. Explain what we're seeing here.
So we're definitely seeing that private capital deployed quarter by quarter has been growing along with the overall market. So people who are bullish on the market are also bullish on putting more money into startups. We're also seeing funds raise a lot more. So there's just a lot more capital to go around. And with interest rates so low, this is a good place to chase yields.
By your count, how many unicorns are there? Something like over 100?
Over 100 now. That's not entirely clear.
So how many of these unicorns survive?
Well, the question I would ask is how many of them were going to survive anyway? So, maybe a third of them survive to getting to IPO, a third of them get bought out, and a third of them die. That's probably roughly the outcome.
So a third of the unicorns will survive?
Maybe not even that many.
So what determines whether or not they make it?
Ultimately, I think if you look at historical IPOs, they have to be trending towards profitability. That's really, the market doesn't need to see massive profits. It wants to see growth, but it does want to see that you have control. So I think it's going to come down to which companies are able to operate in any environment and continue to get revenue.
So, I want to take a slight turn to Uber. As I mentioned ahead of the show, Uber facing now a class action lawsuit from drivers in California. This is another twist in the ongoing tussle between them. We did get a statement from Uber saying, while we are not surprised by this court's ruling, we are pleased that it has decided to certify only a tiny fraction of the class that the plaintiffs were seeking. Indeed, one of the three named plaintiffs will not qualify. That said, will most likely appeal the decision as partners use Uber on their own terms, and there really is no typical driver, the key question at issue. How big a setback is this?
It's probably not a huge setback for them at this point. I mean, they're a multi-billion-dollar company with probably a lot of other harder problems to overcome than legal issues. It's probably not great PR for them, especially in a time when the markets are questioning if they should be going public or not. But I think ultimately they're growing so fast right now that it's probably just one of a long list of things they need to deal with as they mature.
So when it comes to a quote-unquote unicorn like Uber, how does the shakeout play out for Uber, for companies that are well-funded?
I think the big question is, at some point, if you keep needing capital, is there another investor who's going to write you a bigger check or a check at a higher valuation so that your previous investors feel like they got a markup? At some point, that stops happening, and that's usually when companies have to go public. That's the last investor, and that's the investor that's willing to pay the full market price. So how it plays out is at some point, you just reach the ceiling, and some people wonder if maybe Uber's there.